Hey everybody, welcome back to another episode of ETFs Explained. My name is Jordan Hiley. I'm the mind behind MakeMoreCapital, the financial education brand that just wants to make the world a little bit more financially literate. I want to thank Edgar Flores, one of the commenters on one of my latest videos, mentioning another ETF called ZSP. Now, this is a third Canadian ETF, let me rephrase that. This is a third ETF that trades on the Toronto Stock Exchange so that Canadians can access them through the TFSA or the RSP with their Canadian dollars and don't need to change it into US. These are funds on the Toronto Stock Exchange that actually invest into the US market though. So this is a great way, this ETF among the other two I've covered, are a great way for any Canadian investor to use their tax-friendly account and get great exposure with one fund that is diversified and can help them at least keep their risk at bay knowing that. But yeah, so enough blabbering, I'll dive in. If you haven't seen the videos before where I did VFV and XUS, I'll put the link in the description below. You can go find that one. But I just want to point out as well, all of this information for passive exchange traded funds is found online through Google or through any search engine. You can find this research. That's what makes these funds so great as well. So again, I hope you can get some value out of this and learn how to read through these funds, and you'll be able to do this yourself and show other people that it's really not that complex and you don't need to pay expensive fees just to get your money growing for you. So if we actually search ZSP.TO, which would be the ticker, ZSP referring to the ETF, which is the BMO S&P 500 Index Canadian ETF. The .TO, remember, just helps you indicate that this is an ETF that's on the Toronto Stock Exchange. But I just wanted to point out that to cut to the chase whenever you're doing the research, you can type in the ETF here, but as you can see, it's Yahoo Finance, Globe and Mail, Y Charts. Unfortunately, BMO doesn't actually pop up, like the fact sheet. So one thing that you can always do, so I did end up finding this, which led me to a more technical version of what you would want to look through. But just to help you cut to the chase, doing any research, you just want to type in ZSP.TO, ETF ticker, fact sheet. And you'll find it right there. It's going to be on the first one, and this is the same page. So just want to give you that little shortcut. Always just write fact sheet, and you'll get right to it. And we can learn a little bit more about this ETF now. So it is an ETF that is managed by BMO Asset Management. So again, you want to think of ETFs as look, of course, there's always risk when investing, but these are a great way to mitigate risk. And honestly, the way I view an ETF is like a savings account, because today's savings accounts are getting you less than 0.5%. You know, an ETF that owns the biggest companies in the world is probably going to stick around longer than maybe even a Canadian bank with a savings account. You know what I mean? So you just got to think of it big picture terms, take that step out. But it is managed by BMO. So when BMO creates this ETF, they're picking pieces of the companies that they want to invest in and putting it in this basket. They set this basket on the stock exchange to grow over time so that people can trade what they think the value of it is. And again, that's an easy way to get you exposure into the market in a diverse fund that owns pieces, so that risk is very low. Now, if we go through a few things here, quick facts. So the ETF started November 14th, 2012, so it is going on its 8th year. The total value of money invested in this ETF is $8.9 billion. And the management expense ratio, this is the annual fee that gets taken out every single year from the total investment, is 0.09%, very low. So you can compare this to VFV from Vanguard, which is again the S&P 500 ETF that Vanguard makes. The management fee is 0.09 as well. And then XUS is 0.10. So these are funds that will give you exposure to the US market and make you ensure that you keep as much money as possible, because you're not losing it to those expensive fees that mutual funds carry. But so fund manager, portfolio manager, BMO takes care of this. They put it on the exchange. You just buy it. And dividends are paid out quarterly. So you'll get paid dividends 4 times if you own this, in March, June, September, and December. The only thing though is, of course, as a Canadian investing in the US, there is what's called the foreign withholding tax. So Uncle Sam will take 15% of any dividends that you are owed, and you will get 85% of your dividend payout every time you are entitled and you get them. But of course, any capital gains made in your tax-free savings account, or in your tax-free savings account at least, are completely tax-free. So that is just the toll for investing in the US. But if we look at the ticker symbol, ZSP Exchange, it's on the Toronto Stock Exchange. So again, you can always search up ZSP.TO when you're looking up the ticker. And it's in Canadian dollars, which makes it easy for Canadians to get this exposure. The daily volume seems to be traded around 650,000 times. And I'm not really sure what this references, but been traded many days. And the main thing you want to look down here is the market price. So this is the price of this ETF listed on the exchange. The low for this 52-week low is $35.35, and the high is $46.22. Now, the difference between that and net asset value is, I just wanted to point this out because it's something I've read before, but I do always want to look it up to clarify and improve my understanding. But the NAV of an ETF represents the value of all the securities held inside the ETF. So that is, the 98% of what's in equities and stock, and maybe that remaining 2% that's in cash, or depending on the ETF, whether it has some bonds. But again, we're focusing on these 100% equity ETFs that invest and get exposure to the main US markets. And then divided by the number of shares outstanding. So NAV is basically the real value of the ETF, but then you just need to know that the market price is what you can buy and sell it for on the exchange. So this is what's really underlying on the inside, and this is what you will find on the exchange when you put in a bid in order to say you want to pay this, or put in an ask and say you're willing to sell for that price. Now, moving along, what does this ETF invest in? Remember, anything that is a fund tracking the S&P 500 seeks to replicate the performance of the US broad stock market, net of expenses. So you will get what is after that 0.09 fee, which again is so low, so amazing. Now, these ETFs seek to replicate the performance of this specific index, and it just explains what that index is. So for people that are not familiar, this is a good way to understand just kind of the setup of it, right? The ETF tracks the index tracks 500 companies, therefore this is a fund with pieces of 500 companies created to mimic that set index. Now, you can look here, the top 10 investments in this ETF are Microsoft, Apple, Alphabet, which is Google's parent company, Amazon, Facebook, Berkshire Hathaway, JP Morgan Chase, Johnson & Johnson, Visa, Procter & Gamble, and as you can see, the total number of investments inside of it is 506 companies. So I just want to point this out. How risky is it? They have to say, yes, you can lose money, because yes, you can lose money. And unfortunately, if you don't balance your cash in your checking account well enough, and the market were to have a bad year, and your stock price were to go down, and you were forced to sell, unfortunately, that would be the act of you losing money. It doesn't make you a loser, but that is just, unfortunately, if those were the circumstances, that is how one would lose with an ETF. So the goal is to always contribute a little bit every month, and just build that over time so that you don't have to sell it and you can keep that, your cash account at bay. But so what they say is to look at the volatility. And basically what it's saying is the higher the volatility, the higher your chance of returns. Because again, with investing like anything in life, high risk can equal high return, low risk will get you low returns. So there is a greater chance of losing money if you sell early. But when I speak to any clients, I recommend you invest in an ETF. If you're not ready to hold it for 10 years, don't even start. These are designed to just build wealth long term, and then the beauty of them is that you only need to put $50 a month and you just get the dividend income, right? It's like, again, like depositing money instead of really investing it. It's just in an account that'll get you more money than a savings. And not really an account, it's through an account and into an actual investment, right? But this is how I think we can wake people up to how easy it is to really just set yourself up for your own retirement fund and really just keep more of your wealth. So investment mix, this tells you what the makeup of everything the 506 companies are. So 22.8% is information technology, big tech companies. Healthcare is 14%, financials is 13%, communication 10% goes down. So this again just shows you how diversified this ETF already is. So again, the biggest stressor is over time you will get more comfortable, but don't worry about the day-to-day with an ETF. It's difficult not to worry when, the world is like it is right now with the current situation, but it's important to just know what you're investing in, and that makes it easier to just, keep contributing every month and building that. Now, they actually risk this one as medium risk. A lot of S&P 500 ETFs are usually medium to high just because there's more volatility as these are equities and stocks inside of them, right? ETFs have no guarantees. You may not get the money back, but think about it. For you to get zero, you would need all 506 companies to just fail and disappear overnight. And chances of that happening to these companies is very, very slim, really. So now how has the ETF performed? This is the best part. Whenever I look at these ETFs that track the S&P 500, how wowzers, right? 2013, it returned 40%. 2014, 23.8%. 2015, 20%. 2016, 8%. 2017, 13. Like, you can read that yourself. I don't need to say them out loud, but when you go and talk to a financial advisor at a bank or a sales representative who sells mutual funds, they're not paid to know this, and they don't want you to know this. Otherwise, they don't do their job because you're taking your money out of them and doing this yourself, right? So it's just so important to educate yourself a little bit and understand how you can navigate these ETFs yourself. But that's seriously how this ETF has performed. It has not had a bad year, essentially. And yeah, the numbers just speak for themselves. Now, if you look here, the best 3-month return, so this isn't just the span of 3 months, is 13.8%. Apparently, this was December 31st. I'm sure this has probably changed. It hasn't been updated because this is just January 10th. So once this is updated, I'm sure there might be some changes to adjust to what's going on. But its worst return in 3 months was 8.7. So again, this is a 3-month dip. All you do is don't look at your ETF for 3 months, and you'll be back up to where you would have been. And the annual compound return since inception is 19%. Think about that. You cannot find a mutual fund doing this over long periods of time. It's only Warren Buffett with Berkshire Hathaway has almost been able to do it, or Ray Dalio or Peter Lynch. So it's, yeah, if you'd invested $1,000 in 2014, you would have $3,458, which is pretty great. Now, trading ETFs, what makes these things wonderful is that they trade on an exchange like stock. And sorry, I did want to point this out, is just when you hold an ETF, the idea you want to have it for 20, 30, 40 years. The longer you can hold it, the more money you're going to compound and make. But again, it's so important to treat these like a savings account. Put $50 into your tax-free savings account or your Roth IRA, then just buy 1 or 2 shares, whatever you can. As you get older, make more money, then, transfer more in, buy a few more, and just build this way. But when you want to think of an ETF, you want to think in decades, or just don't even bother with them yet. Once you're ready to, you realize that, well, from 70 to 80, this was a difficult time, and there was inflation. Bonds actually returned like 15 to 20%. But you would still be earning dividends, most likely, if you held from here. From 80 to 90, you would see big gains. From 90 to 2000, you would see big gains. From 2000 to 2010, fortunately, it would have been a difficult time, but this is why you need to balance the cash well and just keep that building so that over time, this is your, the dividends are paying for the dividends pay for your retirement in the future, right? You can live off that dividend income. So, now the market price, now this just kind of goes into the market price versus the net asset value. You really just need to focus on what the market price is. And so for BMO, now I guess we can actually go back to ZSP.TO for this. Oh, always does that. Google ZSP. The market price is $47.04. So to buy 1 share would cost you less than $50. So as long as you're just putting $50 in a month, you can buy 1 share of this, and you will receive the dividends, and you will get all the capital gains growth from U.S. companies. And if you just look at it historically over time, it started at $15.50. It's done a very good job since 2012. Oh, sorry, I misspoke earlier saying 2014. It was 2012 when it was created. But, and again, just to put the context, this here, then the 1,000 being 3,458, that is actually just from putting in 1,000 and then forgetting about it. So I also do think it's worth considering that just by dollar cost averaging over time, you might be buying at higher prices, you might be buying at low. Of course, this is getting in at 15 though, so that's a pretty sweet time if you can get in early and put 1,000. But I just think with ETFs as well, you're aiming for those share accumulation and the dividend income. So you do want to be able to just buy every month too if you can, especially when the price is lower. But who's this ETF for? Investors looking for equity growth. They want exposure in the US and they're comfortable with medium risk. And medium risk just means they understand investing enough to know that this is a pretty safe bet. That's my understanding of it. Again, it's just my opinion. Don't take this as advice. It's entertainment and education for all of you, but that's just how I see it. It helps me sleep at night. a word about tax. You'll have to pay income tax. Depends on the tax laws, but if you use if you hold the ETF in a registered plan. So Canadians, I'm sorry I didn't mean to scare you there, but that means you're safe using a registered tax shelter like the RSP or the TFSA. As long as you're in there, capital gains, well, I prefer the TFSA. Capital gains are 100% tax-free, but the RSP, you do of course get taxed when you withdraw come retirement. So if you can, just do this in a TFSA. That way all gains in the future are 100% yours. You just pay the tax now, use after-tax dollars to invest, but again, that way you know everything in the future is 100% yours, and that's the beauty of that. And how much does it cost? Broker commissions is what BMO actually pays to the companies, and the ETF expense, this is the only thing you're going to pay, is 0.09 every year, and that literally equates to 90 cents for every 1,000 you have invested. You cannot beat the costs of passive ETFs, treating them like a savings account and compounding over time, and that, you know, those numbers again also speak for themselves. So that is really going through this ETF. I might have skipped over some things, but that's just because even myself, someone who understands this, knows that it's fluff and it's really not even that important. The main things, again, you got to look out for is a fairly good average annual return, and of course, past results are not an indicator of future performance, and the world is a bit shaken up right now, so we don't know what is going to happen with economies being closed and the global situation. But it's just important to also remember, though, that like chances are things will rebound, as when markets crash, they always get back up. So just try to trust the process, have faith, and, you know, just start putting a small contribution every month. But that's how you build wealth. You just got to have the self-control to put the money in there and do it. So that is it for this video. ZSP.TO, everyone. This is another great ETF that's on the Canadian exchange that gives you exposure to the US and the S&P 500. So hope you found that helpful, and thank you so much. If you can leave a like, that would be awesome, so it can hopefully help me out with the algorithm. I'm quite new to YouTube, but I will hopefully be making more videos as I go. And then also, if you can subscribe or share, this is just something that everyone should know. This should almost be taught in school, how to look through investments, but of course the rich don't want you to necessarily know that. So anyways, thank you so much, everyone. This is Jordan signing off, and I'll see you next time in the next video. If you have any comments, please leave them down below. Let me know any other ETF you want me to walk through, and I will try and do some more of these videos and help decipher them so you can feel more confident in what you're investing in. Have a great day, everybody.